So first, thank you, Jean, Michelle, for joining us. But I wanted to start by putting a question to the audience. If you could please grab your clickers. One of the things we heard earlier today is the idea that active managers will outperform in a more volatile market. If you could please vote. We'd love to see what the audience thinks about that. Hopefully it will be coming. Okay.
So we have a
So
lot
you have
of
a
active
friendly
managers.
audience here.
We have a lot of active managers. Many of our sub-advisors are in the audience.
So for the unconverted, Jean, what would you tell them?
No, I'll comment on that slide. When I joined the industry a year ago, the public narrative was really about how passive was taking share, how passive was relentless, and how active was not a good value proposition. I'm glad to see that today the public narrative has changed. That being said, I continue to believe that active asset management can be a good value proposition, even in less volatile or in more supportive markets like we've had in the past. So, and what I'd say to the if you want to convert, if you want to use your words, is that I think we've let the public narrative focus too much on fees. At the end of the day, it's about value to the end investor. It's easy to have a conversation on fees because it's visible, it's transparent, or at least so-called transparent, and it's a simple argument for both the regulator and the end investor. But the reality is that we are there to provide value after fees, after cost to our clients. That's a more nuanced debate, and us active managers, I think, have let that public narrative take too much of the public space.
Do you think more volatile markets will help change that dialogue?
Visibly, it seems that is the case, and our investor surveys confirm that. Now, I don't want to stop there because I really believe that what we're doing is the way to go for our clients.
Michelle, what do you think about this idea?
Mm-hmm. Well, truth be told, I've been in the industry for 30 years, an active manager for 29 of those years, and for 8 months agnostic. So our answer is that we believe in active management, and we expect that active managers will prove their worth over time, especially in more volatile markets. And I agree with Jean that the public doesn't have a clear understanding of what they're buying, but I do believe that they feel a bit misled by the markets in general. Obviously, we've had some tumultuous periods and trust has eroded for our industry in general. And so I think a bird in the hand has been what people have focused on, but that will come at a real cost. And the opportunity cost of not being in active management, especially in some of the more inefficient parts of the market, will be a critical factor between people being able to retire or not. So I think it's imperative on our industry to make sure that we provide truth in advertising, we provide value for what we do, but at the end of the day that we regain the trust for the end clients because they desperately do need that alpha generation in their portfolios.
And you regain that trust by performance, or how do you do that?
And I self-selected for a culture that's a fiduciary client-centric core, right? It came from the consulting industry, and now it's an asset manager with $300 billion in assets under management, and largely defines our economic model. And I think we gained trust brick by brick the same way we eroded it, right? So it's not a fast fix, and I don't mean all of us did, but I think that we've made the public so fearful of a decision, especially a wrong decision, with certain air pockets that we've hit over time, and too many options that are too complex for the common person to understand, that as we go through this process of shifting the fact that we'll all live longer, longevity risk, to the individuals and less to the sophisticated institutions, we all need to harness the simplicity of the value proposition of what we do and make sure that clients and prospects, which are police, firemen, nurses, school teachers, it's our moms, it's our dads, make sure that they understand what they're buying. I had a conversation, which I probably shouldn't tell, hopefully he's not watching. One of my sons, who's very bright, is at the University of Chicago, So he's dyed in the wool, going to come out passive. But we were around the table, and we were talking about index funds, and the conversation turned to whether or not you could lose money in index funds. So I think there's lots of misconceptions that exist, that just because something's cheap doesn't make it good for you. And I think we have a lot to do with making sure that narrative is told.
Jean, you look like you wanted to jump in.
On restoring trust, I think, as you said, Michelle, it's bit by bit, but a few things that I, as the CEO of a multi-boutique affiliate manager, say to my colleagues and our portfolio managers is that, one, we need to be very disciplined about capacity. And some of our best performing funds right now are soft close, and it's because they're soft close and we're stringent about capacity that I believe they can maintain that performance. And if a manager tells me I am going to have to soft close or even hard close certain funds, I don't debate. That's in their judgment. They wait to preserve performance. Secondly, I do have a narrative with some of them on closing down certain strategies or funds that do not perform. I was struck to learn last year when I joined the industry that I think 2016 was the first year ever that there were more mutual funds closed than created. Now, I've got over 30 years, I would have expected to happen too. So we need to be disciplined about that. And if we are true to our narrative, to our dialogue, to our value proposition, well, it's value for money. And when it doesn't work, we need to take stock of that. And I think we have not been disciplined. And it's a difficult industry to move because the relationship to the object is long. Time is long in asset management. Yet, if you want to be disciplined, I think you need to show a little more momentum.
Yeah. So I mean, obviously, we've seen a huge move of capital into passive funds. How do you see the sort of what you're describing translate into fund flows? What are your outlooks, respectively, and how do you get more money flowing into the active space?
Well, I do believe volatility will have more funds flow into the active space. I also think that given the enormous pendulum shift that's occurred over the course of the last 5 to 10 years toward passive, there can be too much of a good thing. And the answer is that inefficiencies will occur as you see volatility in those underlying strategies, especially the ones that have been built with illiquid securities that weren't made to be daily traded. And so from that, unfortunately, I think the pendulum will swing back. I think we've already seen it in the last 18 months to 2 years, some asset categories more than others. But I think that the death of active has been largely communicated. And the main point is that active management is needed for the health of the capital markets, for the health and the functioning of our infrastructure. And so, where it stops, who knows? But I think that's largely up to this group, which seems to be large asset managers. But the answer at the end of the day is if it adds value, which I believe it does, we believe it does, then we will find the equilibrium that should exist. And it may be somewhere around these levels. It could be with more passive, but I think it will be with cyclicality in the road rather than the straight line that we've experienced.
Yep. John, what are you seeing in terms of demand for your products and funds?
Well, I would say that, first of all, when we talk about passive share, it still remains a minority portion of third-party managed assets, and particularly true in Europe as opposed to the US. Secondly, when you see the flows, and there was a chart this morning of flows in the first quarter, and when you look at the flows in active, then you need to distinguish into what is performing and what is not performing. And you see a significant inflows into active strategies that perform. And we see that in our group as well. And we've announced our Q1 results, and we continue to see strong flows as we've seen towards 2017. So I think the debate needs to be a little more subtle. And my concern and my focus is less about active versus passive, and more about what is our value proposition versus what I would surmise or propose is mispriced active management, which is largely benchmark again, but which charge high fees or higher fees than they should charge given the relatively closeness of the strategy to the benchmark. And the regulator is starting to focus on that.
Yep.
And that I think, for me, is the biggest market opportunity. If you look at, it's consultants who say that, but if you look at the US market, 35-ish trillion of third-party assets under management, about 8 or 9 would be in these so-called mispriced or underperforming active managers. That's enough for us to earn a living and to bring value to our clients.
So you brought up fees and the value proposition. I mean, what is the outlook for fees? How do you see that evolving in the next couple of years?
Yeah, well, clearly there's been a headwind on fees in general, but that follows the headwind generally in terms of expected returns and low interest rates. But it's also back to what Jean was talking about, the value proposition to the end client. So I think that, the bottom line is this is a great industry. It's a profitable industry. We can reinvest a lot into the business to make a difference for our end clients. But at the end of the day, we have to manage this like any business has, and many industries have. And Beta has covered a lot of our management sins and the proliferation of products along the way. So the fee compression over the last 5 years for active equity has been in the range of 12 to 17%. It's been even larger though, in the 27 to 30% for passive funds. So I think the answer is we're all adapting, as we should, to slightly lower rates along the way to make sure that the value proposition is quite clear. But the averages don't tell the story. The barbell tells the story. And there is an alpha premium, and great managers will make sufficient profit margins and continue to grow. But it'll be, missed the future of the asset management industry this morning, but there will be a shakeout for those that don't add value. You can't charge those kinds of fees. And so I think that's good in terms of alternatives for the clients. And for our firm, our job is to find the ones that can make a difference and to go passive on those that can.
Yeah, Jean, what's your perspective?
Well, I'm going to start with our own experience. Our fees on average are stable to slightly increasing over the past few years. It's a function of mix. I think it's a function also of the discipline we bring to our business, given this equilibrium we have with between our centralized distribution network and our affiliates. We do create some kind of healthy check and balance between distribution and affiliates, and by being focused on capacity, if it performs, it's there, it's rare, and we can maintain, if not increase, our fees. And we have cases within the group of affiliates after having joined the group, having benefited from that in that respect as well. So from my perspective, of course, I don't want to be oblivious to the marketplace. And certain times we have to pay attention to what we're being told by clients. But on the whole, throughout the group, given we have this breadth of strategies, and given the need to go into liquid or illiquid alternatives to generate the yield that investors want or need to meet their obligations, and the ability to have a properly priced framework, then I can maintain our profitability. Now, this is not to say that we're not focusing on cost. We have to walk and chew gum.
So you spoke a bit about kind of a shakeout in the industry. I mean, against this backdrop that you painted, what do you see happening in terms of consolidation, and how important is scale? I mean, Jean, you oversee about $1 trillion. I think, Michelle, you've got about $300 billion. I mean, how important is it to be big?
Yeah, well, I don't think big equals profits. I think focus equals profits, and adding to the client proposition adds to profits. So I see profits as a byproduct of your value proposition at the end of the day. And if you look at big global, not to name names, but they're all public companies and we all know each other. I mean, at the end of the day, you can be managing $1 trillion and not be nearly as profitable or growing by definition off of that larger base. So I think it's more important to be focused and be at scale in what you do and do well. And to truly have a leverageable competitive advantage. And I think that's the key that defines the differences between all of our business models, which is why we don't mimic each other that much. I mean, there are some strategies that add enormous value to the end client, and we seek those out, but they're not leverageable. And there are others that truly are, and those are very different business models. I remember a conference that we attended with with a group of CEOs about 15 years ago, and it was in Boston, and we had all of us up on a panel, and the answer is after 5 minutes, we said we are all in completely different businesses. And I think that's increasingly true for many different companies. So I think it's less about scale, and it's more about scale and focus in the right types of strategies.
Jean, what's your view on that, and in particular in terms of the global reach?
Well, when we talk about scale, I always think of this motto we had in my previous career, but I'll adapt it. In a way, AUMs is vanity, revenues is sanity, and profitability is reality. Cash and operating income is reality. So there's a chase towards size, of course. By being a large organization, there is, of course, an ability to withstand, perhaps to spread more the technology investments we all need to make to adapt to this environment, which is changing fast. So I do see some benefit in scale. A lot of people see benefit in scale because a lot of people come to us and want to join our group because they hit the glass ceiling at some point, be it 2 billion, 20 billion, or even 200 billion. They hit the glass ceiling and they see with us that they can address that shortcoming. On the other hand, as Michel rightly pointed out, the race is not to be the biggest, it's to be the best. And through that, brings profitability.
But do you see to that point, you talked about smaller managers coming to you. Do you see yourself being an acquirer in this kind of environment?
Yes, definitely. Everybody knocks on our door. Now, there's a big difference between the intensity of the discussions we have with managers that want to integrate us and the public talk. But there's also quite a difference between the intensity of the talk on large-scale consolidation, which we have not seen much, and the reality. And ever since I joined the industry, people were talking about there's going to be further consolidation after Aberdeen, Standard Life, Janus Henderson, Amundi Pioneer. The reality is that for large-scale managers, it's not an easy proposition to combine. It's much more difficult than people think, much more difficult than people say. But we see ourselves as a consolidator in any event.
Michel, what about Russell? Where do you see yourself sort of fitting in amidst this broader consolidation trend?
Well, I just joined, so
Yes.
Clearly I
But you're
see.
private equity owned at some point,
No, the answer is I self-selected for a lot of different things. Number one, it's a venerable 82-year-old firm coming on 83 years, and the answer is that I see greenfield in an 82-year firm, which is pretty phenomenal. So from that standpoint, investment solutions, having a fiduciary core, a client-centric core, and the alignment with the owners that we do, and a catalyst for change, right? There's a sense of urgency, and our industry has not necessarily gone through creative destruction. And the answer at the end of the day is we all need to evolve and evolve quickly in order to meet the needs of this developed market and the societal needs of what our industry exists for, which is the retirement needs of an aging demographic. So anyway, I see tremendous things ahead. It's not necessarily in M&A. We see as much in organic growth as we do in M&A, and that's the focus. Investment solutions, fortunately, is an area that everyone's trying to get into. We have 60% in institutional and 40% in intermediary and advisory solutions. So it's a great footprint with 60% in North America, and the rest is all over the world, especially in emerging markets. So it's a phenomenal position to be in. We're very open, opportunistically and strategically to acquisitions, but it would be to grow, not to cut cost.
Got it. I know, interestingly, you both joined your firms last year and took over. I wanted to ask you both what you've changed since taking the helm. Jean, do you want to?
Oh my God, that would be presumptuous for me to say that I've changed a lot of things. The business was in great shape. My predecessor, who passed away, had built this business over the past decade. I think what I may have changed a bit is, as I was saying, this relationship to time. That I think asset management, given we ask our clients to judge us on the long term, given it takes time for strategies to be proven, given it takes time to measure their success, I think we have had a tendency to, in our operations, to also be slow. And I think I've perhaps a little bit enhanced the degree of sensitivity of my colleagues towards the disruption that, or at least the change that our industry is going to face. I must admit I was surprised last year at the conference of a major investment bank. There was about 35 trillion of assets in the room. There was a quiz like you had at the outset. Will there be a newcomer in the top 5 in 5 years? Most people said no. Well, I'm sorry, if you've seen other industries, Airbnb, Uber, the online travel agencies, other industries have been disrupted. I will not assume that ours will not. I have to assume that there's going to be, and I can't spell their name because I don't know who it's going to be. Everybody says Alibaba or Amazon. It's probably somebody else. But it's a reasonable proposition to think that something disruptive will happen, and I don't want a Kodak moment. I'm no a technology expert, and I've not been enough in the industry to be a visionary, but I look around at what has happened, and likelihood that it happens to us is relatively significant as far as I'm concerned. So that's what I'm trying to change, to call the change of a sense of positive urgency. Not emergency, positive urgency.
Michelle, what about you?
I think that's a great lead-in. I use the words amplify and moderate. So I joined a great firm filled with tremendous people, and everyone wants to win. And they want to win for the client, which I've been asked what the biggest surprise has been, and everyone waits for a negative. But the biggest surprise is my sample set of 25 people that I've worked with for 25 years at Russell Investments really was emblematic of the whole firm, which is a huge testament to the strength of the culture. So my first change was to amplify, which was to hire a CHRO and make it a direct report because I see people as a revenue driver. I launched an idea lab where I reached deep and broad into the organization. We have 1,400 people all over the world. And I wanted to make sure that all walks of life within our organization were represented. And one of my colleagues, who's with me in virtually every meeting, sat in on a recent Idea Lab meeting and said he'd never seen me smile so much during an entire presentation where all of these tremendous people from all over the world flew in to give their big ideas that would move the needle 10x, which is the Google 10x term that I tried to indoctrinate within the organization so that we didn't make incremental change. We were making 10x change for the benefit of the clients. And so those are the changes that I think by far are the most important because it's the organization that will figure out how to win, not any one person. And so it's been great to see that.
So interestingly, both of you taking some cues from tech, so to speak. Now, just to wrap up here, coming back to our first question, if you could articulate for us each in one sentence, what is the bull case for active management, as we go forward?
It created the market, it will sustain the market, and it will lead the market to the next leg of growth.
I'll leave it at that.
You'll leave it there. Great. Thank you to both so much.
Thank you.